Welcome, folks. In this video, we're going to talk about fair value gaps, which fair value gap to use, which is the missing link between you and your success in trading. So this is the missing link. This is one of the most important videos you'll ever find. So here is a 15-minute chart. It is a pound USD currency pair. This is a naked chart where you only see price moving up and down, reaching to certain levels, reversing, and all that. Now, what I'm about to teach today, if you understand what I'm saying, will be the most helpful video you'll ever see. As you can see, we're having a bunch of fair value gaps in this chart. Now you ask yourself, which one do I use? Wrong question. You ask yourself, when do I use a certain fair value gap? That's the right question. So let me pull in this indicator. So here you have a couple of days, 1, 2, 3, 4. For this to work, there must be certain things that must align for you to use a certain fair value gap. One is time. At what time do we trade into a certain fair value gap? 2, we have premium to discount. Now, take your fib. You have to define which dealing range are you in. By dealing range, I mean, let's say we are trading, as you can see here, we were trading inside, in between this low and this high. So that's your dealing range. That's when you are that's how you are trading. That's when you're looking for your setups in that dealing range. So to define your dealing range, it's simple. You take your fib, anchor it to that. You must first notice this is the dealing range that you are in the first place. So if you take your fib, like for instance, you anchor it from that low to this high. Mark the 50% of that dealing range, which is that. Now, we're having premium and discount. So these are premium, these are discount, these are premium. On Friday, we're going to talk about Friday's price action so that you can know when to anticipate for a certain move based on time and being on a discount or a premium. Price was here at right before London Open. We're going to talk even about the New York session. So we're having price moving down to a discount. We came off of a premium here. So it came all the way down. Now you ask yourself, what time am I supposed to look for a fair value gap or a silver bullet or a run on liquidity? We have the 2 to, which is here at 2, at exactly 2. We have 2 to 4, or we can extend it to 5. And by this, I'm only referring to the New York local time. So we're having this candle moving all the way down taking out that low. And then you look further to the left. What do you see? We have a fair value gap right there. Is it at a discount? Yes, it is, because we're having that fair value gap right there. We're having this one. We're having also a small fair value gap right here, and also we're having another one here. So they are all at a discount. Now, how do you determine which one to use? Time comes into play right here. We know that we came up to this level, which is this fair value gap right here. So you anchor you mark your fair value gap like that, extend it through. Now, at what time do we get to this fair value gap? At 2:45, which is in between the ICT silver bullet and the top of the hour. So what do I mean by the top of the hour? At every top of the hour, there will be a run on liquidity or a run into a fair value gap. Yes, like that. So we hit this fair value gap. We are trading into this fair value gap right at 2:45. The next candle will be at 3, which is London Open. Here's the fun part. You start looking for your setups between 250 to 310. That is your area. That is your window of time where you look for your setups to form. Here we entering. This candle has 3 in it, and we have already taken out this sell side. Let me mark that. If you listen to this very carefully, you'll get what I'm saying. We've taken out sell side right there. We have traded into a fair value gap. And then now the most important thing, we have 2 factors, premium and discount. We are at discount, so the price is discounted. Number 2, the time aligns. The time aligns because right here is when 2 we reach 2 a.m. So, but we had not yet taken either any low or traded into any fair value gap. Here we have already traded into that, and then price went all the way up. We'll mark this and then go to our 1-minute chart and see how you could use those to frame your entries and also targets, because I always say that a fair value gap takes precedency over everything in these charts, and it's easy to target a fair value gap more than an entry using a fair value gap, which is the most important thing. So you're having this is the New York. We're trading into, we took out this high. Let me mark that. So if you traded from down here, this high will be drawn liquidity, and also this high. So those were the 2 draw on liquidity. So you're having that and that one. We're having these as the most extreme. So we taken that high out, and then we came all the way down, and then went back up again, taking out, we had this high, and then look closer, we have a fair value gap right here, which is at premium. So that means here we are overbought. You don't need an indicator to tell you that. So you mark the entire fair value gap right there. We're also having a volume imbalance right there. So you mark the entirety of that fair value gap. So we are trading into that at exactly what? 8:45. It's not a coincidence. Here we were at 2:45 and here we are trading into that at exactly 8:45. Not that. So we're having this, the London kill zone. Here we're having the New York, which starts from 7 to 10 New York local time. So we have already marked everything that we need during both sessions. So if we head over to the 1 minute chart, here we have the 1 minute chart. Let's start off by this. The 1 minute chart will tell you a very clear story of what's about to happen. You see these relative equal highs right there. That's your first thing to see. We're also having relative equal lows, which got taken out right there. So we have already taken out sell side. What is left is buy side. Every high has a stop loss above it. So you're having every buy side liquidity to aim for. Now, at exactly 2:45, we were digging into, remember this line notes the sell side. We were taking that. We took the sell side right there and then came all the way down into that fair value gap. If you're that aggressive with your entries, look close. Look at this candle right here. It took out that candle right there. At what time? At 2:52. Price is respecting the midpoint of this fair value gap. We trade into that in between the ICT silver bullet. London, here's London open at exactly 3. So London is about to open. So you can be an aggressive buyer in here, anywhere in here after this candle close, and then you see the rejection. So anywhere as price was hitting the midpoint again of this fair value gap, that could be your entry. Enter in long right there. So this will be your entry as price was hitting back into that, placing your stop just below that low. Your first drawn liquidity, these highs, they were quite smooth. And notice that when it came up, it did not take out this high. So that tells you that price will eventually come back and hit that. Here, the same thing happened. This low came, did not take out that low. So does that tell you we are coming back to clear that? So this to make traders feel that we are about to go up and this is support, because we're having a higher time frame low. So this is an area of support. So if you see a double bottom like you see here, it is likely that we are moving back to the upside. Now, time is the Holy Grail. If you want to be profitable, put time being your first. So that gives us a total of 22.87 risk to reward. Here we had the New York. we had the New York. We had news that came in at exactly 8:30, came all the way down, took out that low, went all the way back, taking out that high and trading into the midpoint of this fair value gap. So this is around 850. At 850 to 910, there will be a run on liquidity, which happens right there. We ran on that liquidity, and now it is time to move to the opposite direction. We're having a volume imbalance right here. We're having an inversion fair value gap right there. So any of those could be your entry. You enter on that. If you are aggressive, right here, enter on that, placing your stop just above that high. What could you be aiming for? The midpoint of that dealing range, which is right there. So that's a 6.89R trade. What else could we be aiming for? A fair value gap, an order block, or any other thing that you feel like it's the drawn liquidity. Now, let's head back to the 15-minute chart. When do you know that this will be an inversion fair value gap versus where we come in and then reverse? Now, for example, here we are having a gap right there. The only way to know a fair value gap is going to be an inversion fair value gap is also based on time. At what time are we hitting this fair value gap? It was at 3:45. We went through it, came all the way back down, trading into the midpoint of that fair value gap, and then moved higher. Where is the draw on liquidity? This high. So this fair value gap is below this high. So that means that it's not going to be respected. We are going to pass through it, maybe come back, use it as support, and then move. Now, if we head over to the 1-minute chart, this is where you know that we are going to use that fair value gap as an inversion fair value gap. So this is it. Here's the fair value gap. It doesn't seem like one right here. So we went passed through it, came all the way down one time, came up, went up again, took out that high, came all the way down into a deep discount in this fair value gap, took out that low, went back up again. We had a fair value gap right there, came down again, did not take that low, then went back up again. Then now here we came taking out this low. Now we are bouncing around the midpoint of that fair value gap. This was immediately at 4. So we have already traded past that fair value gap. So that means probably because the draw is to the upside, and look here, this line denotes the 50% of that dealing range. We are at discount still. So there's price must go to a premium based on that range for you to anticipate for shorts. So anything a fair value gap in here will be used as an inversion because we are at discount. Still we are at discount. So now we came all the way. We are bouncing off of the midpoint, as you can see. So that's how you determine if you missed such an entry right here. This will be an entry because we're having this fair value gap being used as an inversion fair value gap. So your entry long, you could enter anywhere in between in these the midpoint, mostly the midpoint of this fair value gap, and then your stop will be below the fair value gap. So this is what I mean. anywhere in there, and your stop below that fair value gap. Then you could be aiming for the extreme buy side. That's a total of 20.84 hour trade. So you have time being a factor. You are at exactly 350 to 410, which is where you look for your setups to form. Mostly look for your setups to form in between the top of the hour. Let's say 350 to 410, 250 to 310. Every top of the hour, there must be a setup that forms. So that was it. So simple. If you listen to this over and over again, you'll come to understand that has always been the missing link, where you don't know what to aim for, what to look, when to look, which is the most important thing. The 1 minute chart tells you the story, the heart of the story. So you ought to have a higher time frame premium or discount array, and then jump into the 1 minute chart and see how it reacts off of that PD array. It's that simple. So that's the missing link between you and profitability, between you and getting funded, between you and everything that you need to know about price. So with that being said, I don't think I have anything else to add to that. And until I talk to you next time, be safe.